This is the Deutsche Bank trade-weighted dollar. It's a daily chart. It's a daily chart, but I've taken it weekly, I should say. And what's so important here is 2011, 12, 13, 14, you can extrapolate right out to the line of persistent dollar strength that we've seen. Valentin Marinov of Credit Agricole joins us this morning. Valentin, this is pushing against consensus, isn't it?
Well, in a way, it's the case that most of my colleagues, including ourselves, really are expecting that the dollar rally will ultimately come to an end, that we may have seen the highs of the dollar index really already last year. And I guess the price action of late may be confounding some of that consensus to a degree. It is important to note, however, that the longer-term drivers or the arguments really in favor of weaker dollar are still very much in place. One of which you've just mentioned, really the flatness of the Treasury yield curve, which ultimately implies or highlights the fading yield momentum that has been helping the dollar rally for so long. That yield momentum is all but gone now.
Is there a flow momentum into dollar as well? If we have yield momentum, folks, this can be either the visible yield or the inflation-adjusted yield. And then also, do we have capital flow momentum in?
Well, it's the case that on today, really, Valentine's Day, I have to say that investors are still very much in love with the dollar. We do see that in our flow data. We do see that in our positioning data. Markets are still very long. The currency that is still the default long in the market. And I have to say that that is partly a function of the fact that there are no real alternatives to the dollar at the moment. While it is overvalued, it is overbought, and indeed has been rallying for so long. And while most of the consensus seems to be predicting some downside from here, it is the case that investors are uncertain why they should be abandoning the dollar just yet, given that it's still the currency with superior fundamentals, not only in G10, but really across the board.
Valentine, could that change if Europe actually becomes stronger? If you look at, the beauty pageants around the world, I have to say the U.S. is looking pretty good compared to emerging markets in Europe.
Yeah, it's still the case. I think the key drawback, or indeed something that is discouraging clients, is valuation. U.S. asset stocks, even to a degree bonds, are looking quite expensive. At the same time, the cost of hedging any dollar exposure really have grown a lot. Again, a function of the flatness in the Treasury yield curve. I guess the one thing that may indeed help or continue to help the dollar from here is just somewhat more aggressive reduction in the short dollar hedges that Eurozone investors or indeed Japanese investors have been running for so long, just because really the cost of maintaining those short dollar positions have become too high. And that may indeed explain why the dollar is doing so well at the moment against the euro, against the yen, the funding currencies, if you wish. I don't think that is actually reflecting renewed inflows into the US assets.
Valentine, do you expect China and Japan to continue buying treasuries at the similar pace to what they've done in the past?
Well, historic evidence is actually going against that. If you look at the last time around when the Fed was tightening, 2004, 2006, a process that ultimately pushed the Treasury yield curve into inverse territory, that was also accompanied by really the end of those purchases, right? Especially in the Japanese case, we actually saw the Japanese investors really stopping from buying really treasuries for an extended period of time. And I wouldn't be surprised if this were to happen before long. To a similar degree, I would think that the Eurozone investors that have been aggressive buyers of treasuries since really 2015, when the ECB announced QE. I think we are seeing some indications that those inflows into the treasury markets are slowing, have slowed down considerably, and ultimately will come to an end.
But what is the measurement this morning, Valentine? And I don't mean at the 2 decimal points, but what is the measurement of quote-unquote flight to quality, flight to U.S. dollar this morning? Is there an emotional component going on right now?
Well, it is part of that, indeed. The dollar is still quite liquid. And if you think of the cash available out there, the dollar cash is still yielding you something close to 3%, whereas in the Eurozone, you're still being penalized by the ECB for holding euro cash. So it is part of the story, indeed. I think what may be driving the dollar at the moment, really, in recent days, is the fact that the reason why the Fed turned more dovish, really, not so long ago, was the concern about the slowdown outside of the U.S. Those risks are now abating. And what seems to be happening in the US rates market is that investors are indeed gradually putting the next rate hike by the Fed on the table. And that is predominantly, I think, the reason why the dollar has been doing so well against the yen, against the euro, and so on. Plus the fact that the dollar remains an attractive, if you wish, safe haven currency, high-yielding safe haven currency.
Valentine, talk to me about some of the really obscure pairs in emerging markets that you like.
Well, at the moment, we think Brazil could still do well. Overall, we like the policy mix that newly elected President Bolsonaro has put on the table. It's also a good carry. If anything, in an environment where the FX exchange rates are really certainly caught in tight ranges, the best that some investors may hope for is just to earn the carry and ignore the direction where the FX markets will be going. The South African rand has been another attractive carry currency there for somewhat different set of reasons. But overall, we also think that with the hope for at least partial trade deal between the US and China, we think Asian currencies could become attractive again. I mean, dollar CNH has attracted some selling of late. We also think the Korean won is looking interesting in this regard. So I think that there are some interesting picks there. And indeed, investors may be more than willing to differentiate, really just ignore the broader picture, but really pick the best performers there.
And Valentine, what do you do with renminbi? So if we have this US-China trade spat actually being taken off the table, what does it mean for renminbi?
Well, we are cautiously constructive, part of the reason being that we expect that the trade conflict and the associated negative growth impact on the Chinese economy will start abating before long. We also note that Chinese stock market still looks quite cheap relative to the US stock market, or indeed even the European stock market. That is already attracting some flows. Just discussions with clients on a broader range of asset classes is highlighting that. So indeed, if all these tail risks about an imminent outright trade war really start abating, investors may start returning there, really. So effectively, the view here is really investors will soon start looking for alternatives to the dollar. At the moment, dollar is the default long. Dollar assets are the default long in the markets. But before long, indeed, Asia or indeed China in particular may start attracting closer scrutiny, closer attention, and that should benefit the renminbi.